This report evaluates the financial performance of RHB Bank Berhad using financial management concept and ratio analysis. Financial management is especially important in banking because banks operate under strict regulation, face high financial risk, and must maintain strong capital and liquidity to protect depositor and investor. Ratio analysis used to assess the bank's profitability, liquidity, efficiency, and solvency. This help explain how well RHB Bank manages profit, expenses, asset, and capital. A 5-year trend analysis from 2016 to 2020 is conducted to identify improvement or decline in performance and to evaluate the bank's long-term financial stability. As a company listed on Bursa Malaysia, RHB Bank Berhad prepared its financial statement accordance with the Malaysia Financial Reporting Standard and Bank Negara Malaysia Regulation, ensuring that the data used is reliable and transparent.
RHB Bank Berhad is one of the Malaysia's leading banking institution and the fourth largest banking group by total asset. Headquartered in Kuala Lumpur, the bank serves individual, SME, corporation and institutional clients. Established in 1913 and strengthened through major mergers, RHB Bank today offers both conventional and Islamic banking services in key products include saving and current accounts, personal financing and home loans, business financing for SME, trade finance, credit cards, RSP Islamic financing product, wealth management service, and insurance related products. RHB Bank has a strong domestic presence and operates regionally across Southeast Asia. With over 100 years of experience, the bank continues to focus on digital banking, innovation, and sustainable financial growth.
Let's start with trend analysis. I will explain each of the ratio. First is profitability, measures how effectively a company generates profit from its operation, asset, and shareholders' fund. Second is liquidity ratio, shows how easily a company can pay its short-term debts using cash or other liquid asset. Third is asset quality ratio, evaluates the credit risk of a bank's asset, especially its loan portfolio. Fourth is capital adequacy, indicates a bank's ability to absorb losses through its capital buffer. Fifth is management soundness, reflects how effectively a bank's management controls operation, cost, and risk. Sixth is leverage ratio, measure how much a company relies on borrowed fund to increase profit. Last but not least is activity ratio, shows how effectively a company uses its asset to generate revenue.
For return on asset, we can see an upward trend from 0.71% in 2016 to 0.96% in 2019. This shows RHB Bank was becoming more efficient in using its asset to generate profits. However, in 2020, ROA dropped sharply to 0.53%, reflecting weaker profitability due to economic challenges. Overall, the bank showed good asset efficiency before the pandemic hit. Return on equity improved significantly, peaking at 11.56% in 2018. This indicates strong returns for shareholders during that period. But in 2019, ROE fell to 9.63%, and in 2020 it dropped further to 5.50%. This decline highlights reduced profitability and financial strain, especially during the pandemic hit. The spread, which measures interest income minus interest expenses over total assets, was stable between 2016 and 2018 at around 1.5%. In 2019, it jumped to 2.16%, showing stronger loan pricing and interest margins. But in 2020, it fell back to 1.36%, reflecting pressure from lower interest rates in the market. Net interest margin grew steadily from 3.45 billion ringgit in 2016 to 5.58 billion ringgit in 2019, showing strong growth in lending activities. However, in 2020, it dropped to 3.89 million ringgit, signaling reduced lending practice and margin pressure. This shows how external conditions affected the bank's core income. Loans to total asset ratio stays fairly stable, ranging between 63% and 68%. This indicates that RHB Bank consistently allocated a large portion of its assets to lending. The slight drop in 2020 to 64.3% suggests more cautious lending during uncertain times. For liquidity, the ratio fluctuated. It fell to 4.32% in 2017, then rose to 9.8% in 2019, showing stronger liquidity management. In 2020, it decreased again to 6.92%. Overall, RHB Bank maintained adequate liquidity, but the changes reflect adjustments to economic conditions.
Next, Next, let's continue to asset quality ratio. First, non-performing loan or NPL. From 2016 to 2020, RHB Bank NPL ratio showed a general downward trend, although there was a slight increase from 2.05% in 2016 to 2.3% in 2017. The ratio started to improve afterward. It decreased to 2.10% in 2018, 1.96% in 2019, and further dropped to 1.52% in 2020. This shows that the bank improved its credit risk management and non-monetary practices, resulting in better asset quality over time. Next, the loan to deposit ratio. The ratio remained relatively stable from 2016 and 2020, indicating consistent fund management. It increased from 91.9% in 2016 and 95.3% in 2017, showing high reliance on deposit for lending. In 2018, the ratio dropped to 90.1%, suggesting more conservative lending. It slightly increased to 92.5% in 2019 before decreasing to 91.6% in 2020. Overall, this shows a balanced relationship between loans and deposit, with no major liquidity issue. Lastly, deposit to shareholder fund. The ratio decreased from 7.62 times in 2016 to 7.17 times in 2017, showing slightly lower leverage. However, it rose significantly to 10.28 times in 2018, meaning the bank relied more on deposit than equity. The ratio then fell to 7.39 times in 2019 and remained stable at 7.28 times in 2020. This indicates that after 2018, the bank strengthened its equity position and achieved a more stable capital structure. Next, let's look into capital adequacy. First, there is weighted capital ratio or RWCR. From 2016 to 2020, RHB Bank RWCR maintained strong and stable. The ratio was 70.17% in 2016, slightly increased to 70.2% in 2017 and rose to 90.2% in 2018, although it declined to 80.5% in 2019 and 70.2% in 2020, it was still well above the regulatory requirement. This shows that the bank maintained sufficient capital buffers and was able to absorb potential losses from risk-weighted assets. Next, the core capital ratio. The core capital ratio increased from 13.61% in 2016 to 16.2% in 2019, indicating stronger capital strength and improved financial resilience. It reached 16.1% in 2018, reflecting effectively capital management. However, in 2020, the ratio dropped to 14.9%, possibly due to higher risk exposure or earning pressure. Despite this decline, the ratio remained at its healthy level and met regulatory standards.
Next, we move to management soundness ratio, administrative expenses to total expenditures. This ratio shows how well the bank controls its administrative costs compared to total expenses. A lower ratio means better cost control. In 2016, the ratio was 41.45%, showing reasonable cost management. It increased to 49.90% in 2017, indicating higher administrative expenses. In 2018, the ratio dropped to 40.80%, reflecting improved cost control. However, the ratio rose sharply to 54.70% in 2019 and remained high at 52.77% in 2020. Overall, cost efficiency improved only in 2018, while in later years the bank faced difficulties in managing administrative costs. Next, we move to leverage ratio. First, debt ratio. From 2016 to 2020, the debt ratio shows the proportion of the bank's assets that are financed through debt. The higher ratio means the bank relies more on borrowing. From 2016 to 2020, RHB Bank's debt ratio remained consistently high, around 89% to 93%, which is common in the banking industry. In 2016, the ratio was 90.9% and it slightly decreased to 89.9% in 2017, indicating a small reduction in leverage. The ratio increased to 93.1% in 2018, showing higher dependence on debt financing. In 2019 and 2020, the ratio stabilized at around 90%, suggesting that the bank maintains a stable capital structure. Overall, the bank's debt level remained high but controlled and within acceptable risk levels for financial institutions. Next, debt to equity ratio 2016 to 2020. The debt to equity ratio measures how much debt the bank uses compared to shareholders' equity. A higher ratio indicates higher financial leverage. In 2016, the ratio was 11.49 times, which fell to 8.94 times in 2017, showing a stronger equity position. However, in 2018, the ratio increased sharply to 16.35 times, indicating a heavily reliance on debt financing. The ratio then declined to 9 times in 2019 and remained relatively stable at 9.37 times in 2020. This showed that after the spike in 2018, RSB Bank improved its equity position and achieved a more balanced leverage structure. So, for the last part of leverage ratio is time interest earned. Time interest earned measure the bank's ability to pay interest expenses using its operating earnings. A higher ratio indicates better ability to cover interest costs. In 2016, the ratio was 1.51 times, but it declined sharply to 0.61 times in 2017, indicating weaker interest coverage. The ratio improved to 1.53 times in 2018, showing better capacity to pay interest expenses. However, it dropped again to 0.84 times in 2019, suggesting increased pressure on earnings. In 2020, the ratio significantly to 1.86 times, reflecting a strong improvement in interest coverage. Overall, the bank's ability to pay interest fluctuated during the period but showed stronger position in 2020.
Last but not least, activity ratio. The first one is inventory turnover ratio. This ratio does not apply to RSB Bank Berhad because bank do not hold inventory like manufacturing or trading company. Therefore, it is not relevant for measuring banking efficiency. Next is net fixed asset turnover ratio. The ratio was 1.99 times, meaning the bank generate 1.99 ringgit of revenue for every 1 ringgit invested in fixed asset. This shows that RSB use its fixed asset efficiently and supporting its operation. Lastly, total asset turnover ratio. The ratio remained low but relatively stable from 2016 to 2020. It was 0.03 in 2016, slightly decreased in 2017 and 2018, increased to 0.04 in 2019 and dropped to 0.024 in 2020. This indicates that asset utilization efficiency declined in 2020. Overall, RHB Bank show moderate efficiency in using its asset with weaker performance during the pandemic years. RSB Bank can strengthen its performance by diversifying income through fee-based services like wealth management, insurance, and digital payments, while keeping administrative costs under control and expanding digital lending. At the same time, balancing loan growth with sufficient liquid assets and diversifying funding sources will enhance resilience. Strengthening equity through retained earnings or capital raising ensures healthy leverage, while maximizing asset use via digital channels, cross-sellings and higher transaction volumes boost efficiency. Continued focus on reducing non-performing loans with stricter credit checks, analytics and portfolio diversification will safeguard assets quality, and maintaining capital ratios above regulatory minimums provide a strong cushion for growth. Finally, tighter cost management, automation and stronger governance will improve management soundness, keeping RHB Bank competitive and sustainably for the future. Thank you.
In conclusion, RHB Bank Berhad showed generally stable financial performance from 2016 to 2020. Despite some fluctuation, profitability improved from 2016 to 2019, indicating good asset utilization and effective lending policies. However, in 2020, profitability declined due to economic challenge, although the bank remained profitable, showing strong resilience. Liquidity remained well managed throughout the time period, allowing the bank to meet short-term obligations while supporting lending activities. Asset quality also improved, as shown by the declining non-performing loan ratio, reflecting better credit risk management. In addition, RSB maintains strong capital adequacy above regulatory requirement, ensuring its ability to absorb financial shock. Overall, the bank demonstrates solid financial fundamental, strong risk management, and good long-term sustainability.